In the closing weeks of 2025, a single shipment of lithium carbonate from a major Chinese producer failed to depart port, citing unspecified production constraints. This event passed without fanfare in global markets, yet it marked the precise moment when available lithium supply effectively reached zero for the commitments already locked in for 2026. The contracts were signed, the deliveries promised, but the material simply wasn't there to fulfill them all. This is not a forecast or a warning. It's a fact embedded in the logistics chains that power the world's transition to electric everything. You might recall the headlines from earlier this year, painting a picture of stabilization in the lithium market. Official reports from industry analysts and government agencies described a gradual recovery from the price crashes of 2023 and 2024. They spoke of new mines coming online in Australia, Argentina, and even the United States, with projections of modest surpluses persisting through 2025. The narrative was one of balance. Demand from electric vehicles was growing, yes, but so was supply, thanks to investments poured in during the boom years. Policymakers in Washington and Brussels emphasized strategic reserves and diversification efforts, assuring that any bottlenecks would be temporary and manageable through trade agreements and subsidies. This version of events, disseminated through financial news outlets and commodity reports, suggested that the lithium ecosystem was adapting efficiently. Prices had bottomed out around $7,500 per ton in mid-2025, then began a steady climb to about $15,000 by year's end, attributed to seasonal demand upticks in battery manufacturing. Experts from firms like Benchmark Mineral Intelligence forecasted that 2025 would see a small surplus of around 175,000 tons of lithium carbonate equivalent, enough to cushion any unexpected spikes. The implication was clear. The market was self-correcting, with no need for alarm. Governments echoed this, highlighting initiatives like the U.S. Inflation Reduction Act, which funneled billions into domestic extraction and processing, aiming to reduce reliance on overseas suppliers. Yet, this account omits certain realities that were evident to those monitoring the fine print in corporate filings and trade data. For instance, while new projects were announced with great optimism, many faced delays due to environmental regulations, water usage disputes in arid regions like the Atacama Desert, and geopolitical tensions in lithium-rich areas. The official story positioned these as minor hurdles, resolvable through technology and diplomacy. It portrayed the supply chain as robust, with companies like Albemarle and SQM expanding operations in Chile, and emerging players in Nevada promising breakthroughs in direct lithium extraction. The focus remained on the positives. Electric vehicle sales projections from the International Energy Agency, estimating 17 million units sold globally in 2025, up from 14 million the prior year, but still within the bounds of available resources. What wasn't emphasized was the underlying strain already building. Inventory levels at key refineries had been drawn down faster than reported, as manufacturers preemptively stockpiled amid whispers of tightening conditions. The media's coverage, reliant on aggregated data from consultancies, presented a smoothed-out trajectory where price volatility was dismissed as cyclical rather than structural. No one was called foolish for believing this. After all, the data seemed consistent across sources, but the omissions were there. Subtle gaps in the reporting of actual production versus planned output, and the quiet cancellations of forward contracts that hinted at deeper issues. As we delve further, consider how this narrative contrasts with details that emerge from less publicized channels. In October 2025, analysts at Rothschild & Co initiated coverage on lithium producers, noting that the market was nearing its bottom, but warning of impending shortages as early as 2026. Their assessment was not front-page news. It circulated among institutional investors, pointing to a mismatch between announced expansions and on-the-ground realities. Similarly, UBS Group AG revised its forecasts in December, predicting a supply deficit starting in 2026 and raising spodumene price expectations accordingly. These updates didn't disrupt the official calm, but they began to erode the foundation of the story being told. The crack appeared on August 5, 2025. When contemporary Amperex Technology Co. Limited, the world's largest battery producer, halted operations at its Jianxiao lepidolite mine in Jiangxi province. This single facility accounted for approximately 45,000 tons of lithium carbonate equivalent annually, representing roughly 3% of global supply at the time. The shutdown was not announced with fanfare. It emerged through regulatory filings and quiet confirmations to suppliers, citing uneconomic conditions amid prevailing spot prices. This detail did not align with the prevailing narrative of gradual rebalancing. While public forecasts from consultancies like Fast Markets projected a modest surplus of around 10,000 tons LCE for 2025, transitioning to a negligible 500-ton deficit in 2026, the abrupt removal of Jianxiao's output accelerated the drawdown of existing inventories far beyond those models. Chinese domestic stockpiles, long viewed as a buffer against volatility, began depleting at an observable rate through port data and refinery intake reports. By November 2025, visible inventories at major ports had fallen below levels seen since early 2023, even as new brine and hard rock projects in Argentina and Australia faced commissioning delays. The shift in authority came from actions taken inside the supply chain itself. In late November 2025, Ganfeng Lithium, one of China's leading integrated producers, quietly rejected multiple spot tenders for 2026 deliveries, redirecting committed volumes to long-term partners at fixed premiums. This move locked in material that would otherwise have entered the open market, directly contributing to a 57% rise in Chinese spot lithium carbonate prices from June lows of around $8,300 per ton to over $13,000 by month's end. No public statement accompanied the rejections. They were communicated privately to bidders, with the consequence manifesting in tightened availability for non-contracted buyers. Similar repositioning followed from other state-aligned entities. Reports from trade sources indicated that Zhangye Mining secured renewed permits for its Quarhan Salt Lake operations, but scaled back planned ramp-ups, prioritizing domestic allocation over exports. These insider adjustments, executed without media coordination, diverted material flows away from the spot market, eroding the surplus cushion that official projections had relied upon. As these moves accumulated, the contrast with headline reporting became stark. While financial press continued to reference healthy inventory levels, from mid-year assessments on the ground metrics told a different story. Refinery utilization rates in China climbed steadily in the second half of 2025, as producers chased higher schedules from battery makers, pulling forward demand that depleted buffers faster than anticipated. The implications extended beyond China. Australian spodumene exporters, facing reduced Chinese buying interest for spot material, saw concentrate premiums spike, even as mine output remained constrained by earlier curtailments at operations like those of Mineral Resources and Pilbara Minerals. The system, designed around assumptions of elastic supply response, began showing rigidity. Capacity idled at low prices proved slow to restart, and new projects carried multi-quarter lead times. This convergence of a specific shutdown date, a quantifiable volume removal, and coordinated corporate reallocations marked the point where the official story of manageable transition gave way to evidence of structural tightening already underway. The system revealed its fracture through observable discrepancies in delivery and pricing mechanics. By mid-December 2025, Chinese spot lithium carbonate prices had climbed to an average of 98,000 yuan per ton, with trading ranges extending from 95,000 to 102,000 yuan, marking an 8% increase in the final weeks alone. This upward movement occurred against a backdrop of visible inventory drawdowns, as port stockpiles and refinery buffers fell to levels not seen since the early phases of the 2023 surplus buildup. Refineries reported operating at elevated utilization rates to meet contracted volumes, yet spot availability for new buyers contracted sharply, forcing premiums on immediate material to widen significantly over long-term agreements. Trading halts were not formal, but effective equivalents emerged in the form of delayed deliveries and canceled tenders. Multiple downstream cathode producers confirmed that scheduled shipments for Q1 2026 were deferred indefinitely by suppliers, citing force majeure tied to raw material constraints. One major Australian spodumene exporter quietly suspended new spot sales in November, redirecting all output to existing offtake partners. The consequence was immediate. Non-contracted battery manufacturers faced delivery delays of up to 3 months, pushing some to bid aggressively on whatever marginal volumes remained available. Inventory disappearance became quantifiable through customs and port data. Visible stockpiles at major Chinese ports dropped below 1 month of industry consumption by late 2025, a threshold that triggered precautionary buying from mid-tier players previously reliant on just-in-time procurement. This scramble amplified the premium spike, with spot transactions clearing at levels 20-30% above the average indices reported in aggregated consultancy updates. The demand collision arrived not as a single event, but as the convergence of multiple inflexible requirements. Electric vehicle production schedules for 2026 were already locked in by major automakers, with global sales projections holding steady at over 20 million units despite regional variations. Solar installations continued their expansion, particularly in utility-scale projects backed by long-term power purchase agreements. Military procurement programs, ranging from unmanned systems to portable power packs, maintained steady offtake, insulated from commercial price signals. Grid-scale storage deployments accelerated, driven by regulatory mandates in Europe and the United States for frequency regulation and peak shaving capacity. AI infrastructure added its layer. Data center operators, committing to multi-gigawatt expansions, specified lithium-ion solutions for uninterruptible power supply, and load balancing with build-out timelines measured in quarters, not years. These systems don't wait for price discovery. Contracts were signed at fixed volumes, production lines calibrated, and grid interconnections scheduled. When spot material vanished and contracted suppliers issued delay notices, the response was not curtailment but escalation. Higher bids, accelerated drawdowns from strategic reserves, and quiet reallocations from lower priority applications. The market's attempt to signal through price failed to elicit the expected supply response, as idled capacity remained offline and new projects carried immutable commissioning delays. This rigidity exposed the lie in the earlier assurances of elastic rebalancing. The surplus that had cushioned 2024 and much of 2025 evaporated faster than models accounted for, leaving committed demand staring at an unbridgeable gap as the calendar turned toward 2026 deliveries. The reaction from central institutions arrived not through overt intervention, but through absence and adjustment. In prior cycles of commodity strain, such as the nickel squeeze of 2022 or the cobalt restrictions earlier in the decade, Chinese authorities had moved decisively. Export quotas tightened, strategic reserves released, or direct guidance issued to producers to stabilize flows. This time, they didn't. Beijing's Ministry of Natural Resources allowed the mining permit for CATL's Zhenxiawo facility to lapse on August 9, 2025, without immediate renewal, effectively removing 46,000 tons of annual lithium carbonate equivalent from the system for months. No compensatory measures followed, no accelerated approvals for alternative projects, no public drawdowns from state stockpiles, no directives to ramp idled capacity elsewhere. Instead, silence prevailed as port inventories continued their measured decline through the final quarter, dropping to levels equivalent to less than 4 weeks of refinery consumption by December. Financial institutions adjusted positions accordingly. Major banks, including those with exposure to lithium-backed financing, began raising margin requirements on commodity loans tied to battery materials in November. The People's Bank of China maintained steady liquidity injections into the broader economy, but offered no targeted support for lithium-related credit lines, allowing borrowing costs for mid-tier refineries to edge higher. State-aligned funds, previously active buyers during dips, remained on the sidelines as spot prices crossed 98,000 yuan per ton. This non-intervention extended to trade policy. While export restrictions were imposed on advanced battery technologies in October, limiting outflows of finished cells and certain precursors, no parallel easing emerged for raw lithium imports. Customs data showed spodumene arrivals increasing modestly, yet processing bottlenecks in domestic refineries prevented full absorption, leaving incremental supply stranded at ports. The point of no return crystallized in the failure of physical delivery chains. By late December 2025, multiple Q1 2026 contracts for battery-grade lithium carbonate faced outright rejection from suppliers, with force majeure declarations citing upstream raw material shortages. One integrated producer in Jiangxi formally notified long-term clients of volume reductions averaging 15%, redirecting remaining output to priority domestic battery makers. Another in Qinghai scaled back export allocations entirely, citing compliance with newly clarified environmental quotas. Supply exhaustion became embedded in the logistics. Visible stockpiles at major Chinese ports fell below historical lows for the season, even as refinery runs held near capacity to fulfill existing commitments. New projects, brine expansions in South America, hard rock ramp-ups in Africa, remained on multi-year timelines, incapable of offsetting the immediate gap. Political interference manifested not as seizure or nationalization, but as regulatory inertia. Permit renewals delayed, environmental reviews extended, effectively freezing marginal capacity online. The commitments for 2026, over 20 million electric vehicles globally, gigawatt-scale storage tenders locked in Europe. In North America, data center backup systems specified months earlier could no longer be met through market mechanisms alone. The gap, estimated by private trade sources at over 50,000 tons LCE for the first half of the year, had shifted from theoretical to contractual. The sequence of events bears a direct resemblance to the 2020 repo market panic, when overnight funding rates spiked abruptly as collateral chains seized up despite ample aggregate liquidity reported by central authorities. In September 2019, the Federal Reserve's balance sheet metrics suggested stability, yet a sudden shortfall in reserve balances triggered bidding wars for cash, forcing emergency interventions that revealed deeper structural mismatches. Similarly, here, the lithium market entered late 2025, with consultancy models citing residual surpluses from prior years. While physical flows had already diverged, the extended suspension of CATL's Zhenxiawo operations, initiated in August and persisting without confirmed restart through December, removed material equivalent to several percent of annual global output, accelerating inventory depletion that aggregated data had masked. The parallel extends to the response pattern. In 2020, major institutions maintained public calm even as private repos cleared at elevated rates and dealers rationed access. By early 2026 commitments, battery producers faced analogous rationing. Contracted volumes honored at priority, spot bids rejected or deferred, and premiums widening without triggering formal declarations of shortage. The repo episode resolved only after the Fed expanded its balance sheet by trillions. No equivalent mechanism exists for lithium, where new supply increments require years of development. This precedent reframes the situation from cyclical volatility to regime shift. The earlier surplus built on rapid Chinese lepidolite expansions and Australian hard rock ramp-ups had been drawn down steadily through 2025 amid sustained offtake from energy storage deployments, shipments exceeding 550 GWh globally, and electric vehicle production holding above 20 million units annually. Ganfeng Lithium's chairman noted in November that inventories could be absorbed rapidly under 30 to 40% demand growth scenarios for 2026, a view that aligned with observed port stock reductions and refinery runs near capacity. The real question is no longer whether prices will rise to rebalance the market, but how the embedded commitments, grid interconnection scheduled for mid-2026, data center backup arrays specified in multi-year procurement cycles, military battery qualifications locked in, will adjust when physical material falls short. Price signals alone have proven insufficient. Idled capacity from low price periods remains offline, and regulatory delays on restarts persist. The system has crossed into allocation by means other than open bidding. The allocation has already begun. Priority flows, those secured through long-term contracts with major battery producers, state-backed grid projects, and qualified military suppliers, are being honored at the expense of everything else. Marginal buyers, late entrants, and speculative stockpilers find tenders rejected, shipments deferred, or prices quoted at levels that render downstream projects uneconomic. The market has not collapsed in spectacle. It has simply stopped clearing for all participants equally. This is not a temporary dislocation awaiting resolution through higher prices alone. The lead times embedded in the supply chain, 3 to 5 years for new hard rock mines, 7 to 10 for brine developments, mean that the deficit now manifesting in delivery notices for the first half of 2026 cannot be closed by any project currently under construction. Recycling contributions remain below 5% of primary supply. Substitution pathways, while researched, carry performance penalties that disqualify them from high-density applications, driving the majority of growth. The commitments stand. Electric vehicle assembly lines, scheduled for 2026 model year production, have been engineered around specific cell chemistries and validated supply chains. Utility-scale storage auctions, awarded in 2024 and 2025, carry contractual completion dates tied to renewable integration mandates. Data center operators have locked in power backup specifications months in advance of server rack deployments. None of these systems possess the flexibility to pause without cascading consequences elsewhere. What emerges in 2026 will not resemble the price crashes of 2023 or the gradual rebalancing narratives of prior forecasts. It will be characterized by rationing, quiet, contractual, and increasingly directed by entities controlling the remaining physical material. The spot market, once the reference for global pricing, has already diminished in relevance as volumes migrate to closed allocation. If you're watching this on December 30th, 2025, you're early.